Welcome everyone. Weekly macro update. We are moving it to Wednesday because Monday was a bank holiday. So welcome, team, again.
Yeah, good morning.
So I'll pass it on to you.
Yeah, did you show the disclaimer? Yeah.
Yeah, it's already
Didn't
done.
pop out on my side. Okay, yeah. As Fabio said, Monday was a bank holiday, so we are tuning in on Wednesday. We will keep this sort of schedule for the upcoming holidays. So it's a little bit short this week, but enough stuff has happened, and we will look over it a little bit. And we will do it like we are doing it every time. Always, we'll show you guys some stuff that happens in the last week. So let's get right into it. Let's see, yes, chart from last week. And Monday happens with the gap down like the last 2 weeks. This was bought. Then the week was pretty boring. Keep it like that. And on Wednesday, we had a CPI. So some people are always confused because when you see this mostly on social media, then afterwards, with CPI higher and indices actually higher, you can see the big lilac, let's say red candle here from the initial CPI release 8:30 from Wednesday, that the indices have sold off a little bit, but then they get bought. Okay, so that's the reason why I added the little arrows down here. Positions matter, and I think last week we have spoke about the fact that the market is well aware of CPI coming a little bit higher. If I remember right, I showed you guys a chart of inflation swaps, various tenors out to 10 years, I guess. And yeah, it's always phrased like priced in. I try to avoid those stuff like that because you never know what is priced in actually. But for this side, it was actually priced in. No big surprise here. And just keep in mind, we are dealing with this amount of inflation since like 1 or 2 years. And the stock market is continuing printing new all-time highs. So on these days, even if the print shows big down move, uptick in volatility, keep cool. If you are a day trader, don't jump into this stuff. Do your research, do your process, okay? Because as you can see on the chart, down moves like that, they can actually give you a good opportunity for some extended long trades that you have, because cash sessions so far from the last week, that's the reason we have this red rectangle over here, was pretty boring, okay? So you had just a few chances if you are an intraday trader to trade intraday. On Thursday, we had the PPI, the producer price index, and yeah, it's kind of the same like CPI. If there is no big surprise, there won't be anything sustainable to the downside, no volatility expansion. And also, this is something I read about the PPI component, the PCE component in this shows a little bit of relief, but that's just, yeah, nice to know. It's a weird measurement from the Fed, how they gauge inflation, and we all know they are pretty bad about it. Friday was pretty dull, maybe due to Valentine's Day. No one was on the desks, and we also had a 3-day weekend. So we pinned up there in ES around 141. Let's look a little bit over volatility. It's today in the morning there is expiration for WIX options. So around 9:30, we can a little bit look how WIX is behaving. Where's the settlement? Where the, let's call it, new WIX options will be settled from 9:30 on, and the red bars over here. It's not TA. It's simplified showed where positioning is located in VIX options. And we have a ceiling around 17, and we have a little bit of a floor around 15, 40, 50. Those are areas kind of important if we have down move in SPX, ES, watch those 70 areas in VIX. As you can see from January, stuff can escalate pretty quickly to the downside and to the upside, sorry, and to the downside. That's why I call it the 15 concrete floor. It's pretty stable. There was always demand down there. So people are putting on hedges for whatever reason. 40 50 is not particularly cheap if you compare it to, let's say, the last year. We have seen VIX trading in 12 ELF regions. And yeah, that's maybe due to the fact we had some surprises the last weeks. Think about Donald Trump, think about geopolitical stuff. But geopolitical stuff is good bridge that we built later on. First, half the week ahead. It's already Wednesday. I printed out some stuff that will happen in the US. But as you can see, there's nothing really big that's going on. On Thursday, we have the usual labor market data with the initial jobless claims. There's also FOMC minutes this week, but overall, nothing really special goes on. Friday, we have the Michigan consumer sentiment stuff. That's actually the number from 2 weeks ago. That sends us pretty low during the cash session. Always came out Friday 10 a.m. And I'm not saying it's a tier 1 data set, but the jump in inflation expectations was really, really high. We have spoke about this last week already, and I don't think we have the same move this week. Also, this week on Friday, there's options expiry. I noted that on the left-hand side of the corner. I have a picture from me over this. I don't know if this looks the same on your side, but on the left-hand bottom side, it says earnings, no bigger market movers this week. And on Friday, there's the options expiry for February. So people trading options, do your research how positioning looks like. And I'm always the friend of forecasting what could happen during the monthly OPEX day is kind of difficult. You never know who is closing positions. You never know who is rolling positions. People always tend to say big amounts of gamma are leaving the market and it will reduce liquidity a little bit. To some case, it can be true, but never make a general assumption on OPEX days. So if Friday looks wonky to you, close everything. If you're a day trader, don't fumble around on these days. It's sometimes a little bit difficult to handle these days. Tomorrow there's a little bit of a data print that I will watch because I still have the 6J along, the Japanese yen. We have inflation rates. This week we had also pretty hawkish stances from the BOJ already. That's the reason why I put the 6J trade on it. The only problem here, it trades literally at the same levels like from last Monday when we had the last little macro update. But there was a bigger drawdown to the end from last week. But overall, the story is still ongoing. And for a little bit of color, what's going on with FX markets, there's a little chart with, I don't know why the SPX is in there, but the little white chart on the right side with the blue line is the Bloomberg Carry Trade Index. And as you can see, there's this big dent in the middle of the picture. That's the August 24 blowout where BOJ hiked rates more than expected. So there was a little blowout in positioning for the Carry Trade Index. But we have already reached those levels. So if you have a conversation with someone, you can say them, bro, the carry trade is still going on. I thought it's a little bit of interesting what's going on outside this week, outside from the US, of course, because this picture here is labeled as Europe is changing. And I don't know if you watched recent developments in international policy. I know this is always a little bit of a fuss and pretty hard to make an assumption what happens and what will happen not. But the upper chart here shows you European defense stocks like Rheinmetall or Thales. There's also a Norwegian one, which I forgot the name, obviously. And two peers of it is Raytheon and General Dynamics. So those are trading below zero. That's a chart from the year 24, from the beginning, from January 2025. There's a big outperformance in defense stocks in the EU. Obviously, this stuff has run pretty far. And if you are in this, it's probably wise to hold this if you want to try to have some exposure in those stocks. Of course, it's always a question for our US customers, how they can invest in that, because I don't know if you have access to options for this, because this is mostly traded via physical stocks or European options on the stocks. But it's really interesting that those sectors are outperforming, actually. And the recent outperformance of EU stocks over US stocks was mainly due to the reason they were kind of cheap, right? And mostly those stuff is traded by non-domestic inflows, right? And also all those businesses creating revenue, creating growth in the EU. This is mostly created outside of the EU. We had a little bit of outperformance over there compared to the US market, and much of it was, like everywhere in the world, AI names, but it's really interesting. The defense sector is outperforming. Why is it like that? Because it looks like the US will abandon the Ukraine, if you followed the recent developments a little bit. So the EU maybe has to make their stand over there, and it's likely that those defense stocks will continue their recent performance. On the other hand, defense is always really expensive, and you need money as a country, invest in them, provide aid, be it civilian or be it military aid. Everything has to pay. And that's the reason the other chart shows us European government bonds, German, France, Spain, Italy. And if you compare those charts, it's obviously, what's the story here, right? The trade could be European defense stocks long and short European government bonds. These are 10 years down here. They are falling significantly because the market is well aware the EU has to collect the money. How is the government collecting money? They issue debt that investors can buying. But if you issue too much of it, prices of the debt, so-called government bonds, will fall, yields will rise. Okay, so that's the reason why I put this theme on here. It's kind of a macro theme, and it's cool. You have actually two trades in it, long and short, and the story kind of fits pretty good together here. On the other hand, just have to look at my chart real quick. Natural gas. Just wait a second. Yeah, natural gas up this morning 6% already. We're trading 420s, highs of 17th of January. So why this story? First of all, weather. Weather is really important for net gas. also important to talk about. That's the reason why I put those two graphs together here. We are talking about NG, which is the Henry Hub futures located in the US, domestically used most of the time in the US. The European pair against it is the TTF, the Dutch gas future, as a European proxy for gas demand. The chart shows you they don't run in lockstep all the time, of course. And why is the outperformance of NG this strong this week? Well, severe weather conditions are expected in the US. That's the reason we have this little weather map here from the East Coast in the US on the right-hand side. And now you have to think about it. Why is it always the case you open up your chart in the morning and NG is already up like 5, 10, whatever percent? That's due to the reason if you're managing a gas inventory in the market, so physically gas, right? And demand is picking up because people need to heat stuff. It also works during the summertime because people have to cool their houses. So in gas markets, you always have heating days and you have cooling days, okay? Today we have the heating days driving the bus here. And just imagine you have an inventory of X amount of gas and you need new ones because this inventory will get depleted if people are heating their homes. So we have to manage your exposure in the gas market a little bit. You need new gas. What do? You have to always hedge this a little bit out. You have to buy natural gas futures. So that's sometimes the reason on a bigger time frame, those net gas prices can literally teleport. Like there's no normal movement like in ES or NQ. It's completely different. It's mainly due to actual demand. Also worth to mention we are monitoring the front month of natural gas. So usually the front month gets pretty extended in trading on the downward and the upside. Depends on what the story is. And really interesting. The left chart here down shows us from the CME C-Vol tool, which measures volatility across nearly all tenors that are available on the CME, kind of volatility. Okay, so that's the blue graph. And the blue graph is pretty down compared to what is the spot price doing. The spot price is the dotted little blue line here. This is going up. I also added a skew, which is this lilac pink line over here. Skew for all those tenors is also going down a little bit, but spot price is up. And this is exactly the situation I mentioned earlier. The short-term demand for gas is so high that this movement is only present in the expirations that are really near, right? So it does not mean that the demand is carried out about the term structure for like 2 weeks or 3 weeks. It's just the front month that get those volatility. And that's the reason why if we compare volatility across all net gas expirations, shows us pretty down movements. Now you think, what's the trade in here? And the trade could be to short this move, okay? In futures, well, also in options, you have to have a little bit of, let's say deep pockets, right? Because risk reward wise, you need a pretty big stop trading NG, also holding this overnight. It's pretty risky. On the other hand, it's very rewarding if you are right. And I also added, where is it? This U over here for UNG. And no, that's NG. There's also ETF covering NG markets also. And for options, it's probably better to trade the implied volatility not exactly the price movements over here, because usually it goes like there's a short-term demand to less supply, price is going up, IV is going up, but this has to stop somewhere, right? It obviously has to do with weather, of course, so you have to, in theory, monitor this stuff as well. And then you can put up a trade that the implied volatility, also in UNG, will flow out, and you can sell options over here. But we should be pretty out of the money, because as I wrote down there, there's a pretty high gap risk in those options, of course, because we have spoke about the risk here in natural gas. But it's pretty interesting to see mapping out volatility stuff with the ongoing future, with the front month, what actually happens. And for futures, we also have the data for NG. The problem here is pretty thin. They are not much crowded like indices or other commodities. And on the Netgex chart down here, there's the $4. We have already broke this. We have opened the day around 4. Is it? Wait a minute. Yeah, Wednesday today, 6 in the morning. There was the breakout from 4. We are trading now 425. So you can see it's actually a big movement, right? In the morning from $4 up to 425. That's 250 ticks in futures. One tick, $10, like in CL. So it's already trading above 1 day max today. And normally those moves in futures are coming back pretty big. And if you're watching this today, and if you want to trade it, plan your risk reward ratio a little bit bigger. It's not like a market, like the ES or something like that, where you can work with 20 or 40 ticks. It's not called without a reason Widowmaker, right? So really be careful trading this stuff. But can be highly rewarding, actually. Last but not least, well, it's a short week already, so let's go over US stuff a little bit, and where we are actually. On the left-hand side, I always run those big charts with some sectors. There's everything in it, from financial, energies, discretionaries, also some bond ETFs. That's year to date. All those charts are here that you're seeing are year to date. And it's a grind higher, actually. Outperforming this year so far, financials, the telecom sector, energy. I think it's no surprise anymore that semis lagging a little bit, hand in hand with XLY. Consumer discretionaries a little bit. They are not that trendy as we have them in mind, like 24 or 23 even. But it's fair to say there is no really big outperformer to the downside. Well, all those sectors are moving higher a little bit. Even the, let's call it, boring ones, like consumer staples or the health sector, are moving higher. And as you can see, it's a drift higher, lead by financials, telecom, and energy so far. If we drill down a little bit in the equity space, that's the other chart down here. We have mapped out the IWM small caps, the SPX always as benchmark, QQQ, the RSP, and the ARC ETF. Why those, you might ask? Let's start with RSP. RSP is the equal weighted SPX. So it's not like some tech companies are responsible for 30% of market cap in the SPX. No, everything is equal weighted. That's the orange line. We are shy below all-time highs over here. Long story short, tells you that equal weighted, the SPX is not as strong as it is when you put up a SPX chart. This has to do a little bit with dispersion. And we have talked about dispersion and implied correlations like 2 weeks ago. If you're interested in this stuff, I'm pretty sure it's posted on YouTube and you can look through it. It's not like a 2-hour webinar. It's just a quick and dirty explanation what it is and what it means. But it's obviously visible in the equal weighted SPX like the RSP. Of course, SPX is the benchmark here. What happens in the market? Qs, tech heavyweight sector. You all know the stuff. There is a new all-time high. Those are outperforming, of course. And I always have ARK on my watch because ARK is from the famous Katie Woods. Let's keep it like that. And some say, it's not my words, it's people from the internet saying this, ARK is utter garbage, to say it bluntly. And if those are performing, people are okay having risk exposure in stocks actually, not that stable, not that safe, not that secure. They are okay with taking higher risks. And the ARK ETF outperforms everything on a yearly basis. If you put on a long-term chart, they have been pretty dull to 23, 24, but 25, it's time to shine a little bit. Don't get misled by the performance. ARK ETF can also fall like 5 or 6% on the day, but it's pretty telling that despite we have those big performance on an equal weight basis in SPX, you don't have the performance overall, right? So there is risk taking in the market. People want higher highs, but it seems to be that the participation of the people isn't enough, right? Keep in mind, our first chart was the ES from last week with the 2 arrows, positions. If those positions are getting triggered because spot prices are moving down, people are always there to buy those dips, right? Buy the dip was a thing in 21, 22, and it still is. But room to the upside seems a little bit limited. I'm also in the camp of saying we will see new all-time highs pretty soon. I think the recent performance is tied to positions in the market. If you are into trading options, you should be familiar with this. Like if you have massive long positions over spot, something has to happen that we trade above there, right? It's much have to do with market making and all this stuff. But also, and this will be the last slide of today, there's also in the market always call it passive flows. That's the reason our last slide is about those. I have picked 2 participants in this market, which is a low vol mandate and a CTA. And of course, this topic is really broad. And you can do a webinar about this stuff for like 2 or 3 hours, and you have barely covered every participant in it. But I don't say it's a simple approach to gauge them, but at least I can give you an idea what is also a participant into the market and what they do why they do it. Okay, so let's start with the first one, the so-called low vol mandate. Imagine a long only fund, something like that, that has a simple reason: buy stuff if VIX is below 20, but don't sell stuff if VIX is above 20 because you are long only, right? I know there are products out there like inverse QQQs or inverse SPX. You can buy them and then they are inverse, but just keep it like that. You always have to buy stuff. If stuff is falling, you have hedges, okay? A pretty well-known metric to gauge him a little bit is realized vol with a 1 month tenor and with a 3 month tenor. And I hope it's a little bit visible. I did my best over here. If realized vol on a 1 month basis fall below realized vol on a 3 month basis, that's usually a trigger for them to add liquidity into the market. Why I say liquidity and not trend or buying, because it doesn't always occur, right? All those funds, they have their mandates, they are working according to this mandate. It does not have to mean that your index that you are watching or the index where the vol mandate participates will go bonkers and make new all-time highs or have a strong trend. Most of the time it works kind of good. If you watch the orange bars on the left-hand side upper chart, there are at least 2-3 times where it worked pretty well. On the other hand, it works also on the downside. If the realized vol 1 month crosses the 3 month from the downside to the upside, it's usually a sign for them, okay, step out, don't have exposure, go into hedges, whatever they might be, SPX hedges or vol hedges with VIX. So they won't step into the market, and a little bit liquidity goes down because they are muted, they can't buy, and spot price maybe suffers a little bit. So that's the first one. We talked a little bit about it, and there's also the CTA. They're named commodity trade advisors, but they're trading everything. CTAs are a big thing in the oil market. There was a research paper like 6 or 7 months ago saying 85% daily market participation in oil markets is due to CTA mandates into the market. They're usually trend followers, right? That's the most easy way to explain it a little bit, because they are obviously running different models and you can't address them in a 30-minute webinar like this. So just keep in mind trend following. And the chart on the right hand side on the upper pane shows you in green the calculated by the Mentor Q model CTA positioning in SPX, and in white the SPX chart spot price. There are always divergences, right? It's not like those two charts are going in lockstep. The exposure from those CTAs is pretty dull, right? It seems like they have positions on, and it seems like they don't sell, but it also seems like they don't buy, right? So make a transition to liquidity. I should have brought up a liquidity chart here, but I forget it. Sorry. They don't add liquidity that much to the market. God knows why they are waiting or what's the reason we don't have an uptick here. I can imagine they also are running stuff like, is it expensive to buy now, according to implied volatility and realized volatility? But you never know. The models that they are running, they are so big in variance. But as you can see, there is no big support from that participant into the market. We also have those handy little tables on the left-hand side down over here. And as you can see, CTA positions 1 month, yesterday, today is always compared. Then also the percentiles 1 month, 3 month, 1 year, and the set score, which is standard deviation score. How is it tilted? And the numbers are pretty boring, to put it like that, right? 1 year percentile, we have nearly 0 or 0.05. It's not big exposure. 3 months ago, it wasn't that much better. There's no change to 1 month percentiles. And also position-wise, if we look at the ES minis, CTA positioned 1 month ago, it's 1%, and we barely ticked up over the last month, right? And if you are looking at bigger time frames, not much has happened since January, or let's say since December. We have those big range, and but the reasons behind it, it's really complicated to explain in a short way, because as I mentioned, the reasons why they might enter the market or why not are pretty hard to explain. All right, folks, and that's it for today. Short week means also short presentation.
Thank you so much, Tim. And
yes,
if you guys have any question, please send us an email. You can find us at mentorq.com, and you can find all those charts that Tim showed you within our dashboard. We're going to have a big upgrade on the 27th, so stay tuned for that. We're very excited. And you can find all our live on our YouTube channel. So I think, Tim, for you, we'll see you back on Monday.
Yes, next Monday, usual schedule. Also, the presentation will then, like always, an hour long. But this week, if there isn't any big to cover, I won't waste your time, guys. So it's a short one. I hope you enjoyed it. And if there are questions, as Fabio said, Discord. I also have an X handle, whatever you prefer.
Yeah. Thank you, guys. Have a great day.
Yeah, thank you. Bye-bye.